So this is the lecture about the mortgage markets. Um, the mortgage markets are very important markets all over the world. Unfortunately, these markets are not very developed and very popular in case of Pakistan or the countries like Pakistan. But majority of the countries have got very vibrant mortgage markets, and majority of the people who own houses in those countries are owning those houses only because of the mortgage markets. In the developed world, no one can expect, or no one can imagine having house without the help of the mortgage markets. So technically, every citizen generally, who tries to own a house, he has to go to the mortgage market. They have got very established mortgage markets, and these mortgage markets basically have helped many people actually having their own housing, and they have been able to create the properties, real estate properties for themselves. And not only that actually has benefited to the individuals as homeowners, it has also benefited their real estate industry. Like in the countries where these mortgage markets are working effectively, many people are able to buy and construct their own houses. So that basically helped the real estate market to establish. But again, the countries like ours basically have problems because of the reasons, many of the people are not aware of these kind of markets, first of all. Secondly, because of the religious barriers that we have, like of course that we are not technically Islamically allowed to go into the transactions that basically involve interest. And there are a lot of other reasons, cultural and social reasons, due to which these mortgage markets have not developed in the countries like Pakistan. So here in Pakistan, we actually go for a different kinds of borrowing when we buy houses. Like say, for example, we borrow from family and friends, and generally these borrowings basically become so difficult to return, not only for the people who take money, but also the people who give that money. So, but like that is what something happens. Again, there are many different kinds of Islamic boards of mortgages are available now all over the world. So even if you are religious and you are not basically interested in the conventional mortgages, you have what Islamic mortgages available. That actually is something that is increasing the participation of the Muslims also in the mortgage markets. But somehow it's still that we don't have got a very big, vibrant mortgage market available, due to which the problems basically are existing in the economy, that people are not able to afford their houses. So if you look at the mortgage, what is the basically the mortgage contract? As you are aware that the financial products are more like financial. This is another kind of a contract. Like say, for example, when you make a borrowing, or when you borrow money from somebody, or you lend money to someone, you need to write a document, and that document is basically is this proof which actually defines the terms and conditions for that relationships. Not only the terms and conditions of that relationships, but they also basically help define what exactly you expect from the borrowers, and what the borrowers expect from the lenders. Okay. So this is another kind of a financial contract. And as you can see here on the screen, there is a definition of mortgages. A mortgage is a long-term loan secured by real estate to finance the construction of an office building, or to finance the purchase of a home. It is a long-term loan. Like the basic property of this mortgage loan is that it is a very long-term loan. Like say, for example, most of the times, the schedule that you actually follow to pay back the loan is comprises 10, 15, 20, 30, 40 years even, in some of the instances. So that basically are the loans which basically are secured by the real estate. They are called secured loans, because when you borrow or mortgage your houses, you actually keep your house as a collateral. Collateral means as a kind of a guarantee against the loan that you take. So that makes a lot easier for both of you. You as a borrower actually feels comfortable going to the market and presenting your house or your property as a collateral, or as a kind of a guarantee against the loan. The people who are giving the loan basically are also very much satisfied because they have got a secured asset in their hand in case if you default, if you are not able to pay back the money, that you they are safe on on their own, they can sell their house, sell your house, and they can recover their money. So this actually is a mortgage and a long-term loan contract, which is secured by the real estate. Like say for example, if you are buying a house, this house is mortgaged and this house is placed as a collateral, as a the company that actually gives you the loan has a lien on your real estate. Lien means they have got uh, technically an ownership that basically becomes activated when you are not able to pay back your money. Like say for example, if you have promised to pay back a certain amount of interest on the money that you have got, if you are not able to pay that back, if you are not able to pay back the principal amount to the bank or the company from where you have borrowed this money, your home will be confiscated. It will be auctioned, and the money that they will get by auctioning that house will be used to as a return for their loans and their principal. So this is a fully amortized loan. By the fully amortized loans, we mean you pay gradually the payments, and every payment that you make includes both loan, the principal amount, and the interest. So gradually, this amount that you actually have borrowed falls over time. Like say, for example, if you have borrowed, like say, for example, 1 million rupees and you have to return 1.2 million rupees to the bank, and you divide that 1.2 million rupees in 12 installments of 100,000 rupees each over the 1 year. So every month you are paying 100,000 rupees, and that 100,000 rupees actually have got both elements, the interest as well as the principal. So every month you will be making 100,000 rupees payment. After 12 months, your whole payments will be settled and whole loans will become zero. This kind of a transaction is called fully amortized. The fully amortized means at the end of the loan term, your loans become zero. Okay. So essentially, a mortgage places a lien. Lien, actually, I'm telling you that a lien is a kind of a legal guarantee or the legal kind of ownership transfer to the people who have given you the money, that in case you default, in case you don't pay them back the money, your home will be auctioned and you will not be able to get the house back, and you will actually be only getting the remaining amount after payments to the company that actually has given you the loan. So it places a lien on the property that is not released until the debt is paid. So if the time when you are actually able to make your full payments, you can release that lien and you can get your house free from the threat of being sold in case of not making the full payments. So if the mortgage is not paid, the people who actually have given you the money, they seek a court order and they sell your property. That is called a foreclosure. So foreclosure is a very, very popular term in the case of the mortgage markets. The foreclosure means that if you are not able to pay back the amount that you have borrowed from the bank or any kind of a company, the mortgage company, your home will be foreclosed. That is called the foreclosure. The foreclosure means your property will be sold, and whatever the amount they will get, they will first of all make payments for themselves, and then whatever amount remains, they actually give it back to you. So what is the cost and benefits of mortgage financing? Many people think that you should go for the mortgage financing. Many people think you don't. You should not be going for that. The reasons are many, say for example, there are some cultural reasons. There are some religious reasons. We should respect everybody's point of view about this. Like some of the people think that we should not get or buy a house on interest financing money, because that basically, of course, is not allowed in Islam. It is haram in Islam. But there are many different kinds of cost and benefits that you can attach. And here, basically, we are talking about the economic cost and benefit. We are not actually looking at these kind of things from the religious perspective. We are just looking at that what is the economics of mortgages, what is the economic cost, and what is the economic benefit of getting the mortgage. Of course, that is something can be left on the viewer or the listener, that how he or she understands the mortgage, or he or she goes for that or not. But here, basically, we are going to talk about that what exactly are the benefits and the costs of the mortgage financing that is available to everybody in the world. Okay, so so a mortgage, as you know, is essentially a loan which has to be repaid over a specified period of time, along with the extra payments that you make in the head of interest according to agreed repayment schedules. When you go to the bank and borrow money for your house, you actually promise to make scheduled payments to them, which may be monthly, quarterly, or depending on the your terms and conditions. These loans are suitable for paying for assets, startup capital of businesses, and instances where the amount of money needed is not going to change. If something is the total amount that you are basically borrowing from the housing. Now, what exactly are the benefits of the mortgage financing? Of course, the biggest advantage is that the many people who are not having enough money can borrow from the bank and can buy a house. Like everybody dreams for a house, everybody wants to have his or her own house. And this home ownership, like say, for example, you think about it now, like say, for example, you being a graduate from the economics department and working in some area, you are planning to have your own house in the longer run. How are you going to get this house? Because actually a decent house, a small decent house, technically cost you more than 20 million rupees. Okay. If you don't have 20 million rupees, it means that 2 crores of rupees, you are not able to buy a house. So I'm not too sure basically what exactly the salary structure are you expecting and what exactly are you going to get at the end of the day. I don't think basically it is going to be enough for a very long period of time for you to own your own house. Okay. So this is what something is that these mortgage markets basically provide the opportunities to all these working class people because they actually have got, like say for example, when you start working, say for example, if your age is 25 and you are going to retire in the age of 60, so you still have got 25 years of working. So you may actually can go into a contract in which you can basically buy a plan and you can pay that payments. You can make that payments over the life of 20, 30, 30 years, and you may actually be able to own the house. But if you think without kind of this assistance owning a house, it like seems technically difficult because like say for example, if even your salary is 100,000 rupees, 200,000 rupees, or even 300,000 rupees, looking at the kitchen expenditures, looking at the other kind of expenditures of the children and other kind of expenditures, you are not able to save enough to buy a house of 20 million rupees or 30 million rupees. Okay? So one of the benefits of having this market is the home ownership. Many people are able to own their houses during their lifetimes. That's is something that basically is a very strong plus as far as economics is concerned. Um, Another benefit of this particular kind of a borrowing is that they are the soft loans generally. The soft loans means their payments actually are made in a very long period of time, and generally the interest rates are not very high. So generally, I'm talking about generally because many of the countries encourage their banking sector, as the government of Imran Khan initially basically emphasized on this, and they wanted this banking sector to help people own their houses. So they actually were having a very vibrant plan, which actually was to reduce the interest payments to the housing on the housing loans, and that is something can be very helpful for the people to divide their whole payments in a long installments. Like say, for example, if you are making payments of your amount, over the next 30 years, of course, it's a long period, and you can divide your payments accordingly. If there's very short installments that may not be very much, difficult for you to pay, being a good earner at some place. So another very good advantage, economic advantage again, I'm not talking about the religious advantages or disadvantages. It is the development of the real estate industry. If nobody buys a house, nobody constructs a house, many of the people associated with the real estate industry will be laid off. They won't be able to get the job. Like, say, for example, right now, it is getting very, very difficult to construct your house because of the iron bars prices, because of the cement prices, because of the other kind of the prices that basically you have to pay for your houses to construct your house. There are many people who are discouraged in making or constructing their houses. So that is what basically, like, but if you have, financing available from the bank, that perhaps is very much helpful for homeowners to construct or buy new houses. And similarly, that will help many different industries. Like, as you perhaps are aware of, almost 80 industries are associated with real estate. Like, these industries include iron industry, electric industry, plastic industry, wooden industry. There are many, many industries, and there are many, many things that basically are used in the construction of houses, and that all basically belong to different kinds of industries. So these industries are very much like, depending on the activity in the real estate markets. If the real estate market falters, if the real estate market's activity fall over the time, they basically suffer as well, because, like, the steel industry is not able to sell steel, the electric industries are not able to sell their electric appliances or electric products, and similarly, the cement industry basically suffers because they are not able to sell enough cement to the people. So if you look at the disadvantages of this mortgage market, of course, it makes everybody indebted in the country. Like, there are many countries in which you find everyone has a debt that he or she has to pay. So which creates an extra burden on your salaries. It creates an extra burden in terms of the interest rates that you are making, the payments that you are making over the time. Of course, like, that is, no matter how small that payment is from your salary, every month you have to deduct that amount and have to pay to the company or the bank. That basically becomes painful in some instances. Another problem, that is the risk of default, and like that happened in the US in 2007 and 2008. Many people defaulted on their home loans. They didn't pay the money, and that basically caused a large auctions of the houses, which caused a large fall in the prices of the housing, and that basically triggered another kind of the crises. So there could be a price risk of default. Like, if you look at even the countries like Japan, the US, UK, Europe, you find many people have become psychologically or ill because of the, like, the burden they feel of the payments that they have to make for the mortgages they have taken. But of course, like, that is one of the problems. But again, potential for negative equity, like, sometimes it happens. And this similar example, like, a very good example we have had from 2007 2008 financial crisis. What happened during that crisis, that the house prices fell. So sometimes what happens is, like, say, for example, if you have borrowed $100,000 on a house that was initially valuing at, say, for example, $110,000. But over the time, what happens, that the price of house falls. Say, for example, if the price of house becomes, say, for example, $80,000, because of the market demand and supply conditions, that the price of the house falls. Now you have to pay $100,000 on the house that's true value is $80,000. So that actually creates a negative equity. So that is what something very difficult for the people, and that is what exactly happened during 2007 crisis. Many of the people thought that if they don't make payments to the banks, they will lose $80,000. And if they make payments to the bank, they will have to make payments of $100,000, because the money that they have borrowed on their houses, basically the houses actually lost their values. So if you owe $100,000 on the house of $80,000, you will basically can default, because by defaulting you will be saving $20,000. Because if you're making payments, you have to make $100,000. But if you default and you actually leave your house for the bank, and the bank confiscate that house and auctions that house, you will be only losing $80,000. So mathematics tells you that you can actually avoid $20,000 extra cost by giving up the house. That's what basically happens when the potential negative equity actually arises in terms of the houses. Another problem with this mortgage market is that, there are a lot of this contract is not easy to undertake. Initially, this is a very long-term contract. Many of the people basically and many of the banks basically have got a lot of fear, a lot of they are scared of it, that what exactly is going to happen in the longer run. They are not aware of it. So it actually involves a lot of cost of uncertainty of the long run. Like say, for example, I am paying you now and you are returning me in 20 or 30 years of the time. What exactly is going to be in the 20, 30 years, nobody knows. Similarly, the companies or the banks which lends money on the housing, they need to appraise your houses. Like say, for example, if I am a person who has to give you a loan on a house, I need to know that what exactly is the value of your house. If the value of your house is not good, like say, for example, if it is not constructed in a good vicinity or good neighborhood, its value is like say, for example, $80,000. You cannot ask me to lend you $100,000. And there are for that you need appraisers. You need to call people who could look at the property value and who could basically find out what exactly are the values of that house, and they basically are needed to evaluate the investment strategy that basically we are going to make. So that costs a lot. There is a huge cost involved into it. This is called closing costs. And of course there are interest rate risks. Many of the installment, many of the mortgage transactions basically are based on the variable interest rates. So in case of the variable interest rates, the both parties basically are at risk. Like say, for example, if the interest rate increases, the people who have borrowed money can be at loss. And if the interest rate falls, the people basically who have lent money will be actually at loss. So there is a kind of interest rate risk involved into this. And similarly, if the property value fluctuates, things can basically become so bad for the banking sector and for the people who are basically, having loans. Actually, this is relative to the potential for negative equity, there where we can see that, home value may decline, which may cause a lot of trouble for both banks and the person who has basically borrowed money. Now, who operates in the mortgage market? Many people basically, play their roles in the mortgage market. Of course, the biggest role is played by the borrowers and lenders. The borrowers can be, of course, individuals or households who actually want to have their own house or they want to construct their own house. So they go to the mortgage market and borrow money from them. And there are many lenders sitting in the market who basically have got large sums of money which they exactly are willing to lend to the people who want to borrow money for buying or constructing their houses. There are many mortgage loan originators, the people who assist borrowers in obtaining mortgage loans, including loan officers and mortgage brokers. There are many brokers involved into the transactions between the bank and the people. They actually facilitate the mortgage process between the bank and the people. Another very important player that plays very important role in this particular instance is the government agencies. They basically are regulators, guarantors. They basically, support both the people who are taking loans and the people who are giving loans, because unless they support, there are many people basically, will not be entrusted into this. So another a layer that is added, and this modern system has added to this already established mortgage system is MBS. MBS actually stands for mortgage backed securities. I hope you have heard about ABS. ABS basically stands for asset backed securities. So when the assets that is being used to back the securities or to issue the securities is a mortgage or is a mortgage loans, that is called MBS. So there are many people who basically that they use the mortgages to create more money. So that basically they are the people who basically issue loan, or they borrow money on the basis of the mortgages they have. Like say for example, if the bank has got the mortgage property of say for example 1 billion rupees, what they can do is they can borrow say for example around 1 billion rupees from the market on the basis of the mortgages they have. Now, as you as an individual go to the bank and keep your house as a collateral against the loan that you take, similarly, when the banks and these financial institutions go to the market and borrow money, they use these mortgages as a security for the money they borrow from the market. Okay? So, as you are aware of, there are so many shares underwriters, investment bankers. Similarly, you have got mortgage underwriters. These mortgage underwriters are the professionals who assess the risk associated with mortgage loans applications, ensuring they meet lending guidelines and criteria. So they are the underwriters which initiate the mortgage process, and they help both the banks and the people. Similarly, like the insurance companies, there are many insurance plans available for the both the people and the government, the banks, which actually provide insurance against the default, and if the payments are not made or if something bad happens with the property, the companies basically are there to help them out. So these are the mortgage insurance companies which are available in the market. Now, as far as the term of the financing is concerned, as you are aware already, that this particular loans are very long-term loans. So technically, their lifetime may be 15 to 30 years. Okay, so this is what basically is the term involved into this. What is the collateral? Why these loans are called secure loans? Because the collateral means the guarantee that basically is there with the people who are issuing the loan. As you know, that the house that you basically borrow on, that is used as collateral. Okay, so this is a pledge. You just make your say a house as a pledge, as in your house. Sorry, you pledge your house as a security, and that basically gives the issuing or the lenders to help them that save their loans. So types of mortgage loans, when you are going to the bank to borrow money, you have two options. Either you take a fixed mortgage loan or you take variable mortgage loans. In some of the instances, this choice is available with the borrower, but in some of the instances, this choice is not available. You have to go for either of it, depending on the basic launch of the program from the bank. Sometimes the banks force you to buy variable, rate mortgage, but there are some kind of mortgages that are also available, which are available at fixed rate. Now, what does that mean? The fixed rate mortgages are also called conventional mortgages, are loans with a fixed rate of interest for the life of the loan. Like, say, for example, if you have fixed payment loan, and that can be very for the whole period of the payments that remain the same, no matter how large or how small this interest rate become in your country. Like, say, for example, if you fix your interest rate at 20%, you will be paying that 20%, no matter if the interest rate actually becomes 20% in the market or it becomes 10% in the market. So in both of the instances of the increase and decrease, neither you will be having more cost nor you will be having a less cost. So you will be paying a similar amount every period, that is something that is going to be. But technically, the companies and the banks prefer going into the variable rate mortgages. And these variable rate mortgages are basically, are called adjustable rate mortgages. These adjustable rate mortgages are the mortgages that are given and taken at the rate that change over the course of loan. Say, for example, if the interest rate in your country increases, your cost, your mortgage payments may rise. If the interest rate of your country decreases, your payments, your monthly payments for the mortgage may fall. So it can go both ways, but it suits to the generally the people who lend money, because they do not want to put themselves into the risk of the fixed interest rates. So technically, you are at the risk of the interest rates. Like, say, for example, the similar thing again happened in 2007, 2008 financial crisis. Initially, when the people were borrowing money for their housing, the interest rate was around 1%. I'm just talking about the late 90s and early 2000. the interest rate in the US was just 1%. So when they were borrowing the money for their houses, the interest rate was 1%. So 1% interest rate means they were actually expected to pay a very small, interest rate on the mortgages that they were getting. But what happened over the 5 to 6 years period, like in the US, the interest rates increased from 1% to 6%. So that increase basically broke the back of many of the people who were basically relying on a very low interest rate mortgages. Initially, when they borrowed money from the banks, their cost liability was calculated, their interest rate liability was calculated at the rate of 1%. But over the years, this 1% became 6%. So they were actually, if say, for example, one person was initially paying $1,000 per month from his salary, so his roughly, I'm just talking very roughly about it, by the increment of extra 5 percentage points on your interest rates, this liability perhaps would have risen to $5,000 to $6,000. Again, this is rough estimate. There is no kind of calculation involved in this. So it means that, like, say, for example, if the person who was planning to pay $1,000 from his salary every month in the mortgage, payments, if that particular amount becomes $5,000 to $6,000, of course, that becomes so huge, and that becomes very much difficult for the people to go with. So this is something happens. So in that particular instance, like what happens is that the banks basically want to keep themselves safe in the face of interest rate uncertainty. Now, if we look at the different types of the mortgages available, again, unfortunately, Pakistan's mortgage market is not very developed. Many of the products that you are looking at here will not be available in the Pakistan markets. Pakistan's market are not available in the Pakistan's market just because that on the first place, we don't have got a very strong mortgage market. At the second place, the people are not interested in exploring the opportunities in the mortgage markets. So many of the people basically, rely on benevolent contributions, BCs that are called. They basically, they accumulate amount over the time by, having these BCs and these benevolent contributions within your family, within their families, and within their friends. So, but they generally don't explore the opportunities of borrowing money from the bank to buy a house. So, but technically, all over the world, these different types of the mortgages available. One is the buy down mortgage. That is a buy down mortgage. Actually, is just a simple mortgage, but with a different kind of a contract. The contract is like, say, for example, what happens is that initially when you buy a house, you do not only borrow money, but you also use your own money to buy the house. Like, say, for example, what happens in the modern times is that is a musharka, that is a partnership takes place between the people and the bank. Like, say, for example, you pay 20%, the bank pay 80%, you pay 30%, bank pays 70%. In similar way, that some percentage is paid by you and some percentage is paid by the bank. So generally, whatever the percentage you take, actually, or you just just go for the responsibility of, you basically make all your payments, you use all of your money. So initially you don't have enough money to pay back the interest and to give the money back to the company from where you have borrowed the money. So technically you are interested in some kind of insurance in mortgage contracts in which initially you have to pay low amount. Like, you have a choice. Initially you pay a low amount and then this amount increases over time, or you initially pay high amount and over the time this amount falls. So it's your choice. But in the case of buy down mortgages, initially you pay low amount and over the time the amount that you have to pay in terms of interest rates increases. That gives you a breathing space in the beginning. That provides you a chance to take a breather in the beginning. Like, in the beginning you are not supposed to make a very large payments, so you basically can be easy initially, but later you have to pay a high amount of the interest rates. Okay, so in case of the buy down mortgages, the interest rate payments gradually increases over time, and you save money in the beginning, but you have to pay a big amount in the end. So there are different kinds of pros and cons of it. That all kind of the transaction depends on that what kind of mortgage you are interested in. So another type of the mortgage is called the second mortgage. What happens is, like, say, for example, when you borrow money against your house, or against your real estate property, generally you get loan according to the value of your property. Like say, for example, if the value of your house is 10 million rupees, you may be able to get 800,000, like 8 million rupees, or say, for example, 9 million rupees of that house. Suppose you initially, when you borrowed money, the value of your house was 10 million and you borrowed 9 million on that 10 million rupees house. Now, what happens over the time? The value of that house increases from 10 million to 20 million, say, for example. Now, technically, like, on the basis of the initial formula, initially you were able to borrow 9 million rupees on a 10 million rupees house. So now, since your house value has risen to 20 million rupees, now technically you are able to borrow 19 million rupees on that 20 million rupees house. Now, although, like, that you can technically, now if you would have gone now in the market, you could have borrowed 19 million rupees on the house that actually has got the value of 20 million rupees, say, for example. But since you actually, like, have already taken a loan on that house, you are not going new to the market, so you actually have just taken 9 million rupees on the house, which has a value of 20 million rupees, the market value. Okay. So what exactly happens is that there are different kind of banks that offer you second mortgage. The second mortgage is the mortgage that you take for the extra, like, value increase in your housing. Like, say, for example, the value of your house has risen by 10 million rupees, and that 10 million rupees can make you entitled for another 9 million rupees loan. So a second mortgage is like an extra loan you can get for your home when the value of your home goes up. Okay. So this is called the second mortgage because it comes after the first one. You still make your regular payments for the first loan, and you now make, like, the payments for the new loan as well. Another opportunity in the world is available about the reverse mortgages. Reverse mortgages are a very popular kind of a mode of mortgages all over the world. Why is this called the reverse mortgage? The reverse mortgage is, like, that what happens is, like, say, for example, if you are getting older, what you do is you get your house mortgaged. Now, your house is mortgaged. Like, say, for example, the bank actually has got the lien on your house, but you are not borrowing money, anything. But what exactly is happening? The bank is paying you installments. Why? Like, say, for example, you might be interested into this. Like, say, for example, if you are old enough that you cannot work, you need a regular stream of income. To get this regular stream of income, you may get your house mortgage. And as, like, technically the young people pay for their house, like, they didn't own the house and they basically, like, have bought the house and they are making payments to own that house. You technically own this house. This house is yours, and you are actually receiving some regular payments on the basis of that house. Now, the company or the bank which actually is giving you monthly income, uh, and they basically are secure because they have got your house as lien. They have got the lien on your house, and if you die or you sell the house, they get their money back. So a reverse mortgage is like a special loan for older people who actually have got their homes. The simple mortgages are for those people who don't own the home. They borrow money and they buy the home. Okay, and for that they make the payments. Now basically it is happening opposite. That's why they are called the reverse mortgages. That you are a homeowner, you have a home, and you want to use that home to actually generate a regular stream of income. So what do you do basically? You give that house as a, like, just accept the lien of a bank on your house, and the bank basically pays every month a certain amount to you, which may be good for you to live, like, the time basically you are passing. So you basically can, if you die or you basically sell the house, then basically the bank will be able to get their money back along with the interest rates, of course. Okay. So with a reverse mortgage, a homeowner receives a sum from lender secured by the value of the home and does not pay the loan back as long as he or she lives there. The lender is repaid, including fees and interest, when the borrower actually sells his house or he dies. Now, there is a very, we need to learn about the dynamics of the mortgage market in Pakistan. Of course, our overall financial sector is not very developed. We have a very weaknesses into our financial markets because of the less participation of the people. Like, there are many people who do not participate into the financial markets. Like, even if you think about yourself, you being, even although you are students of financial markets, but many of you do not have bank accounts. Many of you do not have got investments in the stock markets. Many of you are not related somehow directly to the financial sector in terms of savings or lending or borrowing. So it is actually showing that how less participation is there of the people into the financial sector. So similarly, as you have got other financial markets undeveloped, you also have got the mortgage market, which is very, very significantly underdeveloped. And this actually is a challenge for both. Like, you as a individual household cannot borrow money because the mortgage market is not established. Similarly, the companies which basically are selling the house are also facing the brunt, basically, because if the people are not able to get the mortgages, they will not be able to buy a house. So according to International Finance Commission report of 2021, Pakistan is facing housing shortage. It requires an estimated of 10 million new houses. Pakistan required 10 million new houses to facilitate growing number of people in the Pakistan, and to basically facilitate those people who don't own their houses. So it requires an estimated of 10 million new houses, a number expected to grow by 400,000 units per year. So every year, as the new population is adding to the Pakistan's population and new people are entering the Pakistan, you will be requiring 400,000 new houses every year. So Pakistan actually is facing very rapid urbanization. Many people are shifting from the rural areas to urban areas, and that is what causing a growing need of affordable housing in Karachi. Like, say, for example, you are now growing up, you must be dreaming for your own house. You must be dreaming that you own a house and where you can live with your family, with your wife and children, or with your husband and children. And you basically are looking for some kind of affordable housing. But of course, the value of the houses have become so high. You are imaginably, it is not easier to even imagine that you are going to own a house that values 20 to 30 million rupees. So you are actually, because, like, say, for example, when you start your work, you get 100,000 rupees at max, or even less than that. So how come you can basically secure or save many 100,000 rupees to buy a house? So that actually is a dream, but of course that is the land prices is continuously increasing, and it has become very, very difficult for a average household to own a house, especially for the low and middle income groups. It's not easy for you to get a house. Now, if you look at the Pakistan's financial structure, in Pakistan, we have got around 25 commercial banks, Housing Building Finance Corporation, HBFC, which is the only specialized housing bank that basically provides you the loans. So HBFC is the only specialized housing bank in the country which has been providing housing loans to the public sector, since public people, since 1952. This is another statistics, again driven from the different kind of the newspapers. So I was telling you initially from the IFC report of 2021. It is a similar kind of a statistic that there is a huge supply-demand gap in Pakistan, which is around 10.10 million around housing that you require, and that basically is increasing. The however, housing finance only accounts for 0.5% of the GDP. 0.5% of the GDP. So overall, if your GDP is $100 or 100 rupees, just 50 paisa of that particular economy is basically is used for house financing, which actually has made very difficult for the people to afford houses. So in 1994, the government decided that the HBFC should operate as a market-oriented financial institutions. So commercial banks entered the mortgage business during 2003. contributing very small share in the housing finance because of the fear, because they are not interested in lending for that particular long period of time. Only few commercial banks extended housing loans during 2020. In 2015, the government of Pakistan also launched another project that was called the PMRC. PMRC actually stands for Pakistan Mortgage Refinance Company. And they also created a specialized bank that was called Exim Bank of Pakistan, which was basically for that housing kind of a problems. They were formed to promote, develop, and improve housing financing to increase the availability of affordable housing. But both models of finance, Islamic and conventional, were included in this program. So according to 2017's paper by Shahid, the average loan amount disbursed by the banks remains in the bracket of 2 million to 8 million rupees, which is also very below what an average house cost in the major urban centers. So the amount that they were basically giving was not enough for the people to buy the houses. So there are different kinds of things basically have happened. During the last term of Imran Khan, basically they started a Naya Pakistan housing program, which incentivized 100,000 homes for banks and construction industry to incentivize real estate businesses. So a limit of 2.5 million was set on the loans under the program. But that was a good program because according to that program, they were expecting many people to own their housing. So the government first time got so much involved into this housing markets. So this particular kind of steps relaxed many of the requirements from the bank, which actually made a lot easier for the people to borrow money. Okay, thank you very much for joining us.